Hello and welcome to the Restart Michigan webinar, Tax Policy Implications of a Biden Presidency. I'm Lori Ostro, I'm the Senior Director of Engagement with the Detroit Regional Chamber, and I welcome you to today's session. The Chamber launched this series of webinars to help businesses across the state get restarted and continue their operations through the pandemic. I would like to thank our guest speakers today from Deloitte for volunteering their time to share their expertise. Before we get started, I wanted to make sure you are aware that all of the participants are on mute for today's session, but you do have the option to submit questions through the GoToWebinar control panel. Those questions will be monitored throughout the session. I will now turn the webinar over to David Parent from Deloitte.
All right, thank you, Lori. And as a member of the Chamber Board and as Deloitte's managing partner here in Michigan, I also would like to welcome you to this session. I'm very pleased to introduce our two speakers today, both my colleagues from Deloitte. Jon Traub is a leader in our Washington national tax practice. For the better part of the past decade, Jon has been monitoring tax policies in Washington and across the country so that we can advise our clients accordingly. Prior to joining Deloitte, Jon worked on Capitol Hill and has significant experience with both tax policy and tax process and brings that expertise to our talk today. Todd Baker is our senior tax leader here in the state of Michigan. Todd has over 30 years of tax experience advising our clients on a broad array of tax issues. As Lori mentioned, if you have questions during the session, I will be helping monitor and facilitate the Q&A. You can use the gray bar on the right-hand side of your screen to submit and write in your questions. We'll try to pause a couple times throughout to answer questions, or you can save them till the end. We hope to leave plenty of time for Q&A at the end. And finally, for those of you who are interested in the materials or taking notes, we will send, the presentation today is an excerpt of a report that we issued about a month ago, and that will be sent out to all participants following today's session. So you may take notes, but you'll also get a full report following this session as well. With no further ado, I'd like to pass it over to my colleague, Jon Traub. Thank you.
Thanks, David. Thank you. Well, thank you all from the Chamber for being here today. I'm going to talk about too much, go back, where we are today, what's going on politically, talk briefly about what Congress did in December, which is actually a fairly substantial COVID bill, talk about Biden's tax agenda, what we think is going to become law, talk about some other tax changes that are on the horizon on sort of autopilot, and close with a very, very depressing look at our fiscal picture. So it starts bad, gets worse, is basically the way to summarize it. Where we are today. So this is, if you've ever been on a Peloton, you'll understand this. On the right side of the screen is your Senate. That's your resistance. That's how things don't get done because the Senate is blocking things. The left side of your screen is your House. That's your cadence. That's how quickly things get done. We've all spent a lot of time looking at how closely divided the Senate is, just 50-50, with a tie-breaking vote being cast by Vice President Harris. We spent much less time thinking about the House, how closely divided that is, with respect to the very narrow majority that Republicans have, the Democrats have there, and really can only lose a handful of votes on any single measure before they need to turn to Republican help. And so that's been the underreported story of 2021, and one I think we should all keep a very close eye on because there are major implications for what can get done politically. There are probably 6 major ways policies get done in DC, and there's probably variations on a theme on here, but the 6 major ways I think of, and we're going to focus almost exclusively on the top bar because I'm a congressional politics person. But the Congressional Review Act is something to keep in mind. It's a way Democrats can undo regulations issued in the waning hours or waning weeks of a presidential administration. They can pass with a simple majority vote. The procurement process, buying from minority-owned businesses or small businesses, or Buy American, is a way to influence policy by buying things. Executive orders on things like immigration, climate change have a major implication for U.S. policy. Enforcement and oversight. Does the IRS spend as much time enforcing and auditing low-income individuals taking the EITC, or do they spend more time auditing people, high net worth individuals and big corporations? All have a big implication in how the tax code is sort of experienced by customers. And lastly, rulemaking. So Congress passes laws, and then the agencies write rules to implement the laws. And many times there's substantial gray area, and the rulemaking process often fills in not just missing details, but critical details in how laws operate. Again, we're going to focus really on the first of these 6 items, but keep in mind as we watch what happens in the Biden administration, all of these are ways for policy to be changed and for have a big impact on you and your companies and your families. So in December, Congress did what it had not done for most of the year, which was pass a big, big bill. If you remember the early part of 2020, Congress was very active on the COVID stuff, passed 3 major bills in March and April to try to get a handle on the pandemic, help the economy through what we think of as being in a period of suspended animation while we try and sort of get through the crisis. And then Congress went dark and they sort of retreated to political shells and political posturing. And then post-election, they produced a very large, dramatic bill, which had additional COVID money relief. It had money for states and localities hit hard by disasters. It had a big package of tax extenders. This is a annual tradition in Congress of passing a bill to extend on a yearly basis temporary tax relief. So on the COVID piece, I think Todd's going to jump in here as well, hopefully, but big change to clarify that if you took a PPP loan that was forgiven, you could use those PPP amounts and they create deductible business expenses. IRS had issued a notice that sort of said if you have the forgiveness, you can't get the deduction, which sort of was given with one hand and taken with the other. Congress said, no, we meant to have a full free ride on this money. An expansion of the deduction for business meals and entertainment. This was at the insistence of the White House over the objection of Democrats and Republicans in Congress. The employee retention tax credit, a way to keep people attached to their employers, was extended and expanded. More tax credits for employees giving paid sick leave and family leave to their workers. Some pension relief, some additional $600 check for individuals, more charitable deductions, all in that package. Todd, anything to add on the ERTC?
Yeah, thanks, John. Yeah, with respect to the employee retention credit, we've seen this be a huge benefit for companies in Southeast Michigan, and the changes that take effect in 2021 is they basically increase the credit rate to 70% from 50%, while also increasing the limit on the wages that's applicable to. So effectively, it's $7,000 per worker is the cap per quarter for 2021. The other 2 big items, number one is before, to the extent a company or taxpayer had received PPP loans, you were not eligible for the employee retention credit. That has now changed. You can still be eligible with respect to that, and that is retroactive to 2020. In addition, the other big opportunity is companies with less than 500 employees can, where before that threshold was 100 employees, can qualify and do not have to do employee by employee analysis as to the amount of the restrictions based on COVID. So it's a real big opportunity for a company that otherwise qualifies to basically include up to basically 500 employees in that benefit.
Yeah, good, very good point, Todd. Thank you. The other thing that was in that bill that was interesting was a substantial extenders package. As I noted, Congress has a variety of tax rules that they bump along every couple of years. And what they did this in December was actually make a number of these items permanent, including a special tax rate applied to the makers of craft beer, wine, and spirits. I think we can all agree that while we owe a great deal of gratitude to our frontline healthcare workers, just behind them in the pantheon of heroship are the craft beer, wine, and spirits makers who have kept us somewhat sane during the pandemic. Other provisions got a 5-year extension, new markets tax credit, CFC look-through for multinational corporations. And then other provisions got a shorter extension, generally 2 years for most energy items, and 1 year for a couple of items that really are sort of hanging on by a thread, like a special 3-year depreciation rule for racehorses, et cetera. And so what's sort of interesting is what this means is that in the past, the theory behind extenders was, let's not stand out from the crowd. If the whole crowd's moving forward, we will be able to sort of ride in the slipstream and hang with the others, which has worked in the past. But now with the most popular ones having been made permanent or extended for 5 years. The ones hanging out on the right side of your screen that have only gotten a 1-year extension are sort of looking around saying, well, who's going to be our champion? Who's going to pull us along? Who's going to provide a slipstream for us to draft behind? So really potentially a big reshuffling of the deck on extenders when we get to the end of 2021. All right, to the main event, Biden's tax agenda. And I want to talk about this in kind of reverse order. Former Michigan Congressman, kind of a legend, John Dingell, many of you worked with him in his time in Congress, said something like, I'm paraphrasing now, but basically said, if we're going to debate something in DC and you can choose the policy and I can choose the process by which we argue it, I will win 9 times out of 10. And that's right, because oftentimes process trumps policy. So before we talk about what's in Biden's agenda, let's talk about how it gets passed, because I think that's arguably the more important way to think about things. And the term you're going to hear a lot about is budget reconciliation. It is a magical power, not unlike a dragon in Game of Thrones. If you can control the dragon, you have tremendous power. I know that because I saw one half of one episode, so I'm kind of an expert. But a budget reconciliation isn't just any tax bill at all. You have to go through a number of procedural steps. It's quite difficult. First, you have to pass a budget. And a budget is a non-binding document passed by the House and Senate, not signed by the president, that specifies levels of spending and revenue over a particular window, and then says we intend to reconcile those two numbers, either by bringing them closer together or in some cases by driving them further apart. And the entire process can be done by a simple majority vote. There's no chance for the minority party to filibuster. So what we saw happen about 3 weeks ago is the House and Senate passed a budget for FY21, which began back in September, instructing the various committees in Congress to report bills that spend about $1.9 trillion. We saw like 8 or 9 different House committees report their bills out 2 weeks ago. They're then combined into a single bill. That's going to happen this afternoon at the House Budget Committee, which then goes to the House floor for a vote this week. And then that will be voted on later by the Senate and then presumably be passed and signed into law by the president. And this first bill, the $1.9 trillion COVID bill, is almost all rainbows and unicorns and puppies and candy. There's very little medicine in here. There's one small tax increase, but for the most part, this is all spending and stuff people like. We're really focused, for the purpose of Biden's tax plan, on the second reconciliation bill, which I'll talk about in a minute. But I sort of feel like the weatherman on Action 9 News, right? There's a front now over Michigan that's causing some scattered rain showers, but we're really paying attention to a bigger front developing now over Canada, which is going to sweep in our way over the next 3 or 4 days, and that's going to bring torrential rains to the Michigan area. So it's the second reconciliation bill that we really want to think about. And normally, you can only do one bill. Let me go back a second. You can normally only do one budget reconciliation bill a year. So normally you think, well, this is only they've burned their weapon on the COVID bill. But because there was no budget done in calendar year 20, Democrats can do a FY21 budget early this year and an FY22 budget later in the year and get 2 bites at the apple. We saw Republicans do this in 2017. They did one budget early in the year because one hadn't been done in 2016. One budget early in the year became the ill-fated vehicle for the attempt to repeal the Affordable Care Act. A second reconciliation bill was done later in the year that became the Tax Cuts and Jobs Act. So there's recent precedent for 2 reconciliation bills in a year. Now, just because you have a reconciliation bill that has a 50-vote hurdle, meaning it can't be filibustered, doesn't mean you can put anything in the bill you want. There are lots of limitations. Yes, debate's limited to 20 hours, and amendments must be germane. But there's an unlimited number of amendments. There's something called a Voterama. After the 20 hours of debate is exhausted, any senator can offer any amendment he or she wants and compel a vote on it. And it goes until the senators drop dead of fatigue. It can go on for a couple of days, actually. And then there's something known as the Byrd Rule. The Byrd Rule, named for former West Virginia Senator Robert Byrd, places clear limitations on what you can and cannot do in budget reconciliation. And there are 6 Byrd rules of relevance, but we're going to talk about 4 of them today. One is every provision in the bill must have a direct impact on spending or revenue. And relatedly, it can't be an ancillary outcome. So, as an example, a proposal to expand the size of the Supreme Court would clearly have a budgetary impact. That is, you have to pay the salary of another justice or two. You have to have more Supreme Court clerks. You have more housing, more office space, etc. But those budgetary impacts would be ancillary to the policy goal of diluting the current conservative majority on the Supreme Court. We're seeing this play out in real time over the debate on the minimum wage. Democrats argue there's a clear budgetary impact, right? As you pay people more money, they have higher incomes, they pay more taxes, they use less federal benefits. On the other hand, you have corporations who now have less corporate profits, paying less taxes. You have more federal spending on programs like Medicare and Medicaid because many home health aides don't get paid up $15 an hour. So there are budgetary effects, and they're going really in both directions. The net effect would be to actually increase the deficit slightly. Now, the question for the Senate parliamentarian is, are those effects ancillary or incidental, or are they actually central to the policy? And the parliamentarian's judgment here is really, really important. You cannot increase the deficit beyond the current budget window. So normally Congress operates on a 10-year budget. They could do a 3-year budget. They could do a 5-year budget. They've done in the past. They could, if there are votes available for it, you could do a $500,000 a year budget. Now, I'd argue budget projections going out a decade are pretty unreliable. Budget projections going out 500,000 years are somewhat less reliable, but Congress in theory could do so. But the general principle of reconciliation is you can do whatever you want to the deficit inside the budget window in that 10-year period we're operating 2021 to 2030. But so you could take revenues to 0 and spending to infinity, that's fine. But in years 11 through 20, and 21 through 30, and 31 through 40, you have to be sort of clean, have no increase in the deficit. So a common misconception is that reconciliation is by definition a temporary process. No, it's not. It's temporary if you're trying to increase the deficit. So think about the Affordable Care Act, the Tax Cuts and Jobs Act in 2017, or the Bush tax cuts. Those were temporary because if they had been permanent, the budgetary impact of during the budget window would have been carried out into what we think of as the quote out years. Affordable Care Act, by contrast, was scored at the time as actually reducing the deficit long term, so it is quote permanent policy, at least until Congress goes back and changes the law. And lastly, you cannot make changes to Social Security. Most of the first 3 items are sort of create surgical strikes or surgical points of order. But if a bill changes Social Security directly, that is a fatal flaw that cannot be fixed. The bill itself is dead. Now, these rules are not self-executing. There is no objective standard here. What will happen is the Senate Republican staff and Senate Democratic staff will huddle in closed doors with the Senate parliamentarian, and she will make an advisory ruling saying, I think this does or doesn't violate the Byrd rule. Things that the parliamentarian says, and that process is known, by the way, of course, as a Byrd bath. And provisions that the parliamentarian says violate the Byrd rule are dropped from the bill, and they're known as Byrd droppings, because sometimes Congress does have a sense of humor. There's a discussion that maybe Democrats would ignore the parliamentarian's ruling and overrule her. There's a lot of procedural machinations on that. I can sort of get into the back and forth on that if you want, but that would be a big, big procedural change in how the Senate operates. As I noted, there's something called a Voterama, which occurs after the 20 hours of debate are exhausted, and senators can offer any amendment they wanted. And we thought some interesting fissures develop among Democrats during the Voterama on the budget resolution. Notably, on the bottom right part of the screen, an amendment by Indiana Senator Todd Young to deny stimulus payments to non-citizens was passed, and there's also a proposal passed to block any rule that would ban hydraulic fracturing, or also known as fracking, for production of oil and gas. Those provisions were ultimately stripped from the resolution by a subsequent amendment offered by Senate Democratic leader Chuck Schumer. But what it showed was that there are some key policy issues on which Democrats have some internal fights that they have to resolve, and they may play out when Democrats take up in the Senate the actual reconciliation bill coming up in about 2 weeks. So that's something to watch for. 2022 is fast approaching. I know you're going to say, well, we just got done with 2020. Can we please give politics a rest? The answer is no, we can't. Politics never rests. As I mentioned, Democrats have a very thin majority. The thinnest they've experienced since, I think, before World War II. And history suggests Republicans may pick up seats in the midterms. Notably, in the 7 midterm elections in the president's first term since Carter, so Carter 78, Reagan 82, Bush 90, Clinton 94, Bush 02, Obama 10, and Trump 18. And those In those 7 elections, the President's Party lost an average of 28 House seats. The President's Party gained seats only one time, and that was in 2002, which was right after 9/11. The country was in a kind of an unusual mood. But the other 6 elections, there were definitely big losses for the President's Party. Redistricting may also cause a flight of seats from so-called blue states or Rust Belt states to sort of Sun Belt states, may help Republicans there as well. In those same 7 elections, the President's Party lost an average of 2 Senate seats. And those are sort of hard to generalize because only 1/3 of Senate seats are up every year. Sometimes you have lots of blue seats up, sometimes lots of red seats up. But the point is, Democrats understand time may not be on their side. They're also faced with a very real risk of a health scare. Right? The death or incapacitation of any single senator could upend the balance of power in the U.S. Senate. We saw in January, Mark Warner of Virginia had to quarantine because of exposure to COVID, and Pat Leahy, the most senior Democrat, was taken to the hospital for testing after experiencing some illness that was never disclosed. And so, given the fact that Senate is not a bunch of spry, young, college-age kids, but actually a bunch of septuagenarians and older, the threat of a health scare is very real and something that sort of compels Democrats to feel like we need to act now, not later. So let's get to the good stuff, which is what's going to become law. This is a summary of the key tax proposals put forward by President Biden during the campaign. And as David said, we're going to send you a document which goes through these in much greater detail, at least as much detail as we have. In many cases, the proposals themselves aren't much more than a couple of bullet points on a piece of paper. But let me go through them and tell you what I think actually becomes a law, because I think it's maybe even more interesting than what he's proposed. So the corporate rate is going to go up, I think, not to 28%, but maybe to 25 or 26. The minimum tax on book income, I don't think becomes a law. This was something that sounds great on the campaign trail. Look at company XYZ. It paid $0 in taxes, yet it reported massive profits to its shareholders. That is campaign gold. The problem is, when you peel back the layers of the onion and ask, well, why did this company have big profits but no taxable income? It's generally because of 2 things. One, large capital expenditures, which drive down taxable income, and both parties like companies that spend money on new plants and equipment to make their workers more productive. It's also stock options, the tax treatment of stock options. And while Democrats may have concerns about stock options paid to senior executives, the idea of inclusive capitalism that gives stock options or stock equity to rank and file workers is pretty popular on both parties. So I don't think this proposal is going to become law. Maybe a sliver of it on stock options to senior executives, but even that's a very watered down figment of the bigger proposal. The GILTI rate, the tax on so known as global intangible low tax income, which is applicable to foreign income of U.S. firms, will go up, maybe not to 21%, maybe to 17, 18%. Other limitations that make the GILTI rules tighter, I think, are likely, if not by Congress, then regulatorily. As I noted, one of the ways policy gets changed is by rules that are written by the agencies. Treasury has appointed a number of very liberal law professors to key 8 posts who have written extensively that the GILTI rules provide too much of an incentive for corporations to ship jobs overseas. You can expect that if Congress doesn't do this legislatively, that Treasury will regulatorily dial up the GILTI rules. I don't think Congress will separately pass a penalty on jobs offshore. That's something that we've talked about politically since the 80s, and it's never been done. Maybe there's more impetus to do it now, but it's very hard to figure out which jobs have actually been shipped offshore, which versus which were going to be offshore anyhow. So I'm skeptical this gets done, but you could see some discussion around it. The other side, a tax credit for making things in America, I think is likely to get done in some capacity. The Made in America credit is for rehabbing existing plants or opening closed facilities to encourage more domestic manufacturing. Both parties emerged from the pandemic increasingly concerned about the reliance of American companies on foreign supply chains, often but not always China. And so I could see both parties agreeing to provide some incentives to encourage supply chains to move back to the US. Now, I don't think it's realistic to think companies are actually going to move their supply chains home for a few dollars. Just the supply chains are where they are for a reason. They're complex structures built up over years. You want to be close to your suppliers, your raw materials. You may have skilled labor there. You may have highly developed factories there. But I could see Congress passing something and saying, look, problem solved. The 199 deduction for manufacturing, the 199 deduction for non-corporate business owners likely to get phased out for those with higher incomes. I think that is likely to get done. Let me stop there, Todd. See if you want to make a comment on some of these items, and also see if David has any questions that came in the chat window.
Okay, yeah, John, I wanted to highlight the corporate rate, just like what we saw in years before 2017 when the Tax Cut and Jobs Act was passed. This will be an opportunity, assuming the rate goes up, for companies to be looking at shifting income. Perhaps if you can stomach it, it's accelerating a lot of income, deferring deductions to try to take advantage of that rate arbitrage, given the 21% rate. And same on the individual side with respect to pass-through entities as well, because as you can see, and John will get to, the rates can be expected to be going up there as well.
Yeah, I think this is the inverse of what we saw people doing in 2017. In 2017, we saw companies deferring income and accelerated deductions to take advantage of the current higher rate was going to go lower. I think you're seeing some companies now say, let's do the inverse of that, which is to accelerate income into this year on the chance that the rate's going to go up next year. On the individual side, we do see the top rate likely to go up to 39.6 from its current level of 37. Of all these items on here, that's probably the single most likely thing to happen. I think that there will be some changes to itemized deductions for high income taxpayers, in part because this is how Democrats will find a way to relax or repeal the cap on state and local taxes, which has been a huge issue for taxpayers in what we think of as high tax blue states like Illinois, New York, California. But very complex politics here for Democrats, but I think they do something here. I do not believe capital gains and dividends will be taxed as ordinary income. That would be a bridge too far. You will hear extensive discussion this year from a guy named Ron Wyden, the new chairman of the Senate Finance Committee, about a proposal he's worked on for a number of years called the mark to market. In other words, let's look at your securities portfolio at the end of the year and see how much it's gone up in value and tax you on your unrealized gain. There are a gazillion questions about how this would work, but for sure you'll hear Ron Wyden talk about it. There'll be a major rethinking of how we tax capital assets. I don't believe it's going to become law in a closely divided Senate, but you will hear discussion about it. I think the capital gains rate does go up by a couple of points, maybe mid-20s, but not all the way to 39.6. Carried interest, for those of you who follow this issue, it's a big issue in private equity and some real estate ventures. I don't know. I mean, this to me is a coin flip. Democrats have talked about this issue for 14 years. They haven't done it yet. Is this the year they do it? Maybe, but they had chances before and they didn't do it then. So I don't know. I put this in the coin flip category. The estate tax, I think, does get more burdensome. I think the gift tax amount does go down from 11.7 million today to something lower, maybe not 3.5 million, maybe 5 or 6 million. The rate probably does get dialed up from 40% today, maybe to 45. And lastly, I don't think the proposal on Social Security gets done. As I mentioned, it's a fatal flaw, bird rule point of order. If you touch Social Security and well, you would have to litigate it in front of the parliamentarian. It would certainly appear on its face that raising the payroll tax on higher income individuals is a direct impact on Social Security. So that would appear to me to be outside the realm of what you could do. Now, for the most part, I think these changes are prospective from either the date the bill is enacted or 1/1/22, with two possible exceptions. One is if Democrats decide they've closed a loophole. Loopholes are often closed retroactively, and you could say if they do tax carried interest as ordinary income, which is certainly something they want to do, they might say this is a loophole we've been telling you for years. It's a loophole. We're going to make our changes effective 1/1/21. That's possible. The other place you could see a potential retroactive or quasi-retroactive effective date is if Democrats decide that, or they're told by the official scorekeepers, that making something prospective leads to too much tax planning. So as an example, imagine for a second that Congress decides to dial down the gift tax exemption amount from $11.7 million to $5.5 million, just as an example. If they announce that policy today, what's going to happen? Every wealthy person in America who has the capacity to do so will make the maximum possible gifts they can to their kids and their grandkids before the window closes. And so the Joint Tax Committee estimators may tell Congress, if you let people have a planning window here, it will destroy your revenue. All the revenue will disappear as this planning goes on. So that's a case where Congress might say, not retroactive to 1/1/21, I don't think, but probably date the policies announced. So we're going to announce a policy hypothetically on October 1st that we intend to reduce the gift tax amount to $5.5 million. And if we do so, if we make it retroactive, we intend to make, if we enact it, we intend to make it effective for gifts made on or after today's date. So you're on notice. If you go forward, you're going to be risking it being disregarded. But again, for the most part, these changes are going to be effective 1/1/22, I believe, or date the bill is enacted, but not retroactive. Very small chance of other pieces being done retroactively. Not impossible, but very small chance.
Hey, John, it's David. We had one question around, could you repeat what you said about the base exclusion in the estate tax? What your prediction is?
Yeah, so I think the estate, I think the exclusion amount is going to go down from $11.7 million to something less. I think between 5 and 6 is a likely landing point. And again, I think that could be effective, not retroactively, but on the date the policy is announced. So if you're sitting on a large amount of money you're thinking about giving to your kids, your grandkids, the longer you wait, the more risk you run that you will be on the wrong side of an announced effective date. All right, let's go forward if we can then. As I mentioned, there's some tax changes that are on the horizon, sort of on autopilot. There are key pieces of the Tax Cuts and Jobs Act that are going away. After this year, companies change how they calculate their net income for purposes of the 163J interest limitation test. And we also require companies to begin to amortize rather than fully expense their R&D costs. And after next year, we begin to phase out of full expensing into out of bonus depreciation. And then after 2026, we have a whole slew of changes, many of which were included in the bill in 2017 to ensure that it did not have a long-term deficit impact. And so you combine the 2026 changes with the extenders changes made in the bill that was passed in December, and you're setting up a massive fiscal cliff. Whoever is elected president in November of 2024 is going to face the prospect of a massive change in tax policy on his or her watch that he or she will have to deal with in the first 12 months in office. It'll be a huge, huge, huge fiscal cliff. Let me close with the very depressing look at our fiscal picture, and I'll turn it back to David and Lori for any further discussion. This is where things get pretty bleak. Please put down any scissors, knives, or other sharp objects. This is a chart of our deficit picture as it stands today. The relatively straight lines, so the dark green line and the light green line are the relatively straight, showing the projections from March of 2020, before we knew the full extent of the pandemic. And then Congress did a bunch of spending in 2020. And so the deficit, which was going to be about $1 trillion, which I thought was a lot of money then, ended up being over $3 trillion last year. Then Congress did another bill at the end of the year we just talked about, increasing FY21's deficit even more. And presumably once we add this $1.9 trillion that is being talked about in Congress now in reconciliation bill number 1, the FY21 deficit will get bigger, as will FY22, because some of the money is going to be spent in FY22. The good news, if you want to find it in here, and I think you can if you look, is that the long-term projections are no worse than they were before. So we have a long-term structural imbalance between spending and revenue. And the pandemic has made things in the short term much, much worse, but the long term is really no worse than they were before, and arguably we're slightly better because long-term projection is spending as a share of GDP does come down slightly relative to its pre-pandemic baseline. Now, I think it's hard to understand how much money we're talking about, so let me just give you a number that blows my mind. As I said, pre-pandemic, the projection was our deficit for FY20 was going to be $1 trillion. It's so hard to understand what's $1 million, what's $1 billion, what's $1 trillion. So let me ask you this question. Just think about it in your brain. If you paid off $1 a second, how long would it take you to get to $1 trillion? At $1 a second? As you think, the answer is about 32,000 years. It's an incredibly large amount of money that we're borrowing. And so at 3.1 trillion, it's basically $1 a second for 95,000 years. Which brings me to, I think, my very last slide, which is a variation of the theme. This actually looks a little bit further in the past. And you can see in the late 90s, in the early 2000s, we actually had small surpluses. But for most of our adult lifetimes, we have had deficits of various sizes. What's interesting here, though, is that the green line shows you the average rate on a 10-year note has declined over time, even as we've borrowed more money, meaning the amount we're spending on debt service costs hasn't risen, even as we've borrowed more and more money. That's the good news. The bad news is, if you look at the far right side of your screen, the projections from the official congressional scorekeepers are that the borrowing costs on our 10-year note will begin to rise, not precipitously, but gradually rise. And as it does so, you can sort of see the tail effect is that the debt service cost as a share of GDP also begins to rise. And over time, that begins to squeeze out our ability to fund other things like defense or homeland security or roads and bridges or education or Medicare and Medicaid. And the long-term challenge isn't going away. Congress ought to do something about our deficits. They ought to. They ought to bring spending in line with revenue, either by reducing spending or raising revenue or some combination of the both. But Congress will act in the face of an emergency, either because the bond markets say you're borrowing too much money, we're not going to loan it to you at these favorable rates, or because voters say we're no longer going to vote for politicians that refuse to raise our taxes. We won't vote for politicians that won't cut spending. The latter seems unlikely to happen, but the former at some point I think will happen. And then of course we'll hit a major crisis where Congress will be forced to do something very dramatic very quickly to bring our fiscal house in better balance. I think that's when we end up doing something like a VAT or a carbon tax, not because we want to, but because we hit a real bump in the road where continued complacency is impossible. That's a picture of me and of Todd, our contact information. Let me stop there, turn it back to David or to Lori. That's appropriate.
All right. Thank you both for making the time to present to us today, and Jon for bringing a sense of humor to tax policy topics. There's a few questions, and I learned a lesson earlier as a non-tax guy. I shouldn't try to paraphrase tax questions. So let me see if I get it right the second time. The question was, did Jon comment on the likelihood of repealing the stepped up basis at debt?
Yeah, so that is something that I sort of glossed over that in the interest of time. Biden does propose, in addition to raising the estate tax rate and lowering the exemption amount, to repeal step up basis death, which generally means if you bought or your grandmother or grandfather bought stock in XYZ Corporation 30 years ago, and they hold it till they die, on the day they die, it gets past the heirs with the fair market value on the date of death. It's a way for wealthy people to sort of pass assets and sort of avoid the state tax and the appreciation. That strikes me as pretty hard to do. I'm not saying that's impossible. I put that in the lower odds. I think the odds, the gift tax amount going down, very, very likely. Step up basis, I would put, possible, but much less likely so.
Okay. A couple other questions. Again, I'm going to read this one because I don't know what this means. Any thought on the future of 1031 exchanges?
Yeah, I mean, that was an item that we saw. Biden actually made an obscure a reference to 1031s in one of his campaign documents. 1031, for those who don't know, is a real estate transaction where if you sell one property and buy a similar property within, I think it's either 60 or 90 days, you don't pay capital gains on the sale. It's just the gains rolled into the basis of the second property. In 2017, Congress repealed 1031s for all transactions other than real property. And there was many Democrats who said, wait a minute, who really cares about real property exchanges in 1031s? Who's in power right now? It hasn't gotten much attention since Biden's sort of oblique reference to it during the campaign. I think that's a place where they could go get some money, although I think that needs to be fleshed out more. One thing we'll be looking for, by the way, is that in years past, when presidents have released their budgets, they've included what's known as a green book, which is a detailed outlining of their tax policy proposals. For a variety of reasons, the Trump administration never put out a green book. We expect Biden to put a green book out with his budget sometime, which comes out probably in April or May. And that will give us a real clue as to some of the how hard they intend to press and some of the details behind some of the proposals we've talked about here.
A couple more. My friend Rick DeVore asks, do you see the filing deadline changing to July 15 or some date like that, as has been rumored in some circles?
I don't have any good, it's a good question. And obviously the filing deadlines were pushed back last year during the pandemic. The IRS has opened the filing season on time this year. I have no great insights here as to what they're going to do. I just don't have a real opinion on this one, David. I'm sorry. It's a great question. I just don't know the answer. Maybe Todd knows.
I'd be guessing, Jon.
Yeah.
another question. I think you called these GILTI, G-I-L-T-I. Could you repeat your thoughts on those and how they may change?
Yeah, GILTI is, so for those of you who aren't versed in this, prior to 2017, Congress had, the US had what was nominally known as a worldwide tax system. We taxed American companies on all their income, wherever they earned it around the globe. The 2017 moved this towards a more territorial system, which is what most of the other trading partners have, meaning we will tax you on your US profits. If you earn money in France, you'll pay tax to France, but you then won't pay further profits here. But because of concerns about base erosion, Congress appended to it what was known as the GILTI regime, which is Global Intangible Low Tax Income, which basically applies a reduced rate of tax on those foreign profits, with a couple of exceptions around taxes. You can aggregate among countries, so you can net high tax and low tax income, and you can also get an allowance for physical assets you have in a country, so you can have a normal return on your physical assets. The Biden proposes to substantially raise the GILTI rate. I think the GILTI rate does go up from its current level of 10.5 to something in the mid to high teens. As I said, also, he's got two other proposals to tighten the bite of it. One, by not allowing netting between low tax and high tax countries, and a second, to take away the allowance of the return on physical assets abroad. Many Democrats have complained this just encourages U.S. companies to put more production capacity abroad so they can take a deduction against their actual physical assets abroad. And one of the things I said that I want to make clear is I'm not convinced those latitude changes will get through Congress. I think they can, but if they don't, I could expect you could see the administration write rules to effectuate those changes, because there have been a couple of very progressive law professors put into key roles at Treasury who I think will pursue this regulatorily if Congress doesn't do it legislatively. And the reason why I think Congress gets the first bite at the apple is because, for scoring purposes, if Congress enacts a change, it creates scoreable savings they can use to pay for other stuff, healthcare or infrastructure, climate change, whatever it is. But if it's done regulatorily, there's no scoreable savings Congress can use for other things. So I think Treasury will give Congress the first bite at the apple, but if it isn't done legislatively, I think you could see rules written to tighten down the GILTI exceptions I just talked about on the country by country and on the QBI allowance.
It's been about 30 years since my last tax class. I clearly need to dust off a little bit. I think those are all of our questions for today. I want to thank you both again for making the time to present to our chamber audience today, and I'll turn it back over to Lori to wrap today's session.
Thank you. And thank you again, everyone, for attending. Thank you, all of you from Deloitte, for all of your information shared today. For the participants on the call, you will be receiving an email from me with a link to the video of this presentation, as well as the document that David referenced. Again, I thank you for your time today. Please visit DetroitChamber.com for news on upcoming webinars and teletown halls. And I hope you have a great rest of your day. Thank you.
Thank you.
Thank you.